Okay, everybody, thanks for joining us today. My name is Tim Travis, CEO of TNT Capital Management, and I wanted to update you on a few positions that we talked about earlier, or actually about a month ago now. So the markets have really stabilized quite a bit, and we've seen a really solid recovery. But obviously, there's a lot of uncertainty there still with the tariff issue. Earnings have been coming out. They've been pretty solid. A lot of companies are withdrawing their guidance for the year because there still is so much uncertainty as to how any potential trade deals will materialize or what escalations we'll see. So just to start, investing in financial markets involves a risk of loss. Options are not suitable for all investors, and past performance is not indicative of future results. This is going to be a short one. So on April 8th, we talked about OBDC, which is Blue Owl Development Company. So that's a business development company. They own a diversified loan portfolio. And you own this stock mostly for income. And we like it when you can buy it at a large discount to its book value or net asset value because it's a collection of investments. And then those investments are financed by debt. Assets minus liabilities equals equity or book value. It's a pretty good proxy. It's really like it's net asset value. It's like your portfolio if you have a margin loan or something like that. So if you can buy it at a discount, that's attractive. So on April 8th, it was trading at 12.56 per share, and that's was 26% below its 52-week high. And as you can see now, the stock's at 13.84. So you've seen really nice appreciation, and it's got that nice dividend, right? Where it pays out $1.48 per share a year. And it's still, the stock still trades at a discount to book value. The reason why these trade at discounts, these BDCs, is because people believe that you're going to see increased credit risk if there's a potential recession. So, okay, I think that that's reasonable, but if that discount's too big, like I think it is right now, I think it's attractive. So if you like buying these things, now's a decent time. So that's just one update. Second update is Citigroup. So on April 8th, the stock was at 58.14. And remember, Citigroup's been printing money. They've been doing really well. Is it a great company? No. But the stock, it's sold off because the market catches a cold and the banks get, pneumonia. That's how it works. And so it's sold off a lot. In this strategy, we recommended selling a put. Buying the stock would have been even better as the stocks rallied to 70.24 as of Cinco de Mayo here. So really good. The put's obviously doing really well. It's a very safe position. We have a collection of this. We've bought and sold the stock so many times. We do a lot of different strategies, but this was kind of an options example. So stock is still, reasonably cheap. I think I'd buy it on dips here or sell puts most likely. But that's just a quick update. So here's some recent trades. Okay, so we did this one just last week. So Norwegian Cruise Lines is, a solid company. They got a decent amount of debt, but you got to think of it, it's almost like a real estate operation on the sea, okay? Because these ships are hotels. And so when you build one of these like billion-dollar ships, you're going to have a lot of debt. But the business is booming. It's a much more affordable option for vacation for a lot of people, and I'll tell you from experience. I was super anti cruises. I went on one 15 years ago on Carnival, and I hated it. It was like a 2 or 3 day thing, and like the food was terrible. I hated it. But my wife's family loved them, and my wife really wanted to do one, and so we did one with our kids to the Caribbean on Royal Caribbean, and it was amazing. We had the best time. And since then, we've gone on several others because we enjoy it a lot. It's affordable. You only have to, you don't have to pack your bags or unpack them each different city you go to. And then, it's a good time. You're on the ocean. And so a lot of people are kind of seeing that value. And so the stock, its 52-week high was around $30, and it's come down already. And then it reported earnings. The earnings were a little soft, and so the stock dropped further. And so we got interested. So on April 30th, the stock was at $16.03 per share. We decided to sell puts. So I'm going to show you two different ways that we approach this. So let's say the first strategy is for you're a very conservative investor. you'd love to invest in investment grade bonds, but the yields aren't even this high. And maybe you want a little more liquidity or something like that. Not that those are illiquid, but even more. And so we're going to do something with options. So what we're going to do is we're going to sell the January 2026 $10 put, and we're going to collect 60 cents a share. Every option has 100 shares, so $60 total. Now, the maximum risk on this trade is $940. All right. So heads or tails, flip of a coin. There's two things that can happen, assuming we hold this option to expiration. So if Norwegian Cruise Lines expires above 10 in 261 days, you will collect the full target profit of $60 or 6.38% on the maximum risk, which is 8.9% annualized. Okay, maybe that's not super great for you, but guess what? If you compound at 7% 10 years in a row, you're doubling your money. And you also got to factor in the risk profile, right? If you buy an investment grade bond to get a yield close to this, you're probably going to have to lock in like 7 to 10 years. Or maybe that's a bond that's likely to get downgraded. In this, we have huge protection, which is you're going to see. So tails, what happens if the stock's below 10? Well, if that happens, you're going to own 100 shares at a break even of $9.40, and you'll have all the upside or downside from there. Therefore, the stock could go down 41.36% by expiration before you lose a penny. What did Warren Buffett always talk about? Margin of safety, not losing money, right? And here's a perfect example. Even the stock's already dropped a lot, but it would have to drop 41% for you to even lose a penny. The 52-week low is 14.21. 52-week high is 29.29. So the company should earn about $2 on an adjusted basis. They've locked in most of their bookings and stuff like that. So there's not a ton of variability there. So the PE would be less than 5 if the stock traded at 940 per share. So the stock could easily double. I mean, a 10 multiple is cheap, and it wouldn't take a lot to get there. So that's one example. But what to say, Tim, I want double digits. I'm a little more comfortable with risk. Let's up the ante a little bit. Okay, no problem. So the second example is this. We're going to use the same concept, same valuation principles. We're going to sell the January 2026 $13 put. And on this one, because it's closer to the money, you're collecting $1.35 per share, 135 total. The maximum risk is 1,165. Now, once again, heads or tails? Heads. If Norwegian Cruise Lines expires above 13 in 261 days, you will collect the full target profit of $135 or 11.59% on the maximum risk. This equates to 16.32% annualized. Okay, so now these are the types of returns that get people excited. Double digits in 261 days, nearly 20%. But this has got to be risky, right? To get that. It's got to be risky, I'm sure, right? No, it's not. Okay. So if the stock expires below 13, you're going to own 100 shares at a break even of $11.65. And then you'll have all the upside or downside from there. Therefore, the stock could go down 27.32% by expiration before you lose a penny. Remember, a bear market is defined by a 20% drawdown. This stock's already down materially from its 52-week high. It's not like we're buying it near the top, but it would have to drop another 27% for you to lose a penny. So once again, your break even's 1165. The price to earnings would be less than 6 at that level. This is a fantastic opportunity, and that's what we do. We take advantage of undervalued stocks, and we use tactics to make it even safer. Could you buy the stock here? Absolutely, you can. And we might do that. If it drops further, we'd be more than willing to buy the stock as well. But we're taking advantage of volatility being high right now, because when volatility is high, we collect higher levels of premium, and we can do it at safer strike prices. So this is just an example. These are the types of trades that we're doing all of the time. And I believe that these tools that 99% of advisors don't use are something that really separates our firm. And so here's our contact info. You can look at our new upgraded website. And as many of you know, we use our most popular program is the managed account where we do all this for you. So if you are interested or you know somebody that's interested and could use some help, please direct them our way. Thank you so much. And till the next webinar. Bye bye.